Welcome along to the deep dive.
Hello.
Today we're jumping straight into the source material, getting into Unit 3 of Business Finance.
That's right, specifically Part 3, which is all about financial documents.
And we're really drilling down into one chapter today, Chapter 26, focusing on, well, a really crucial topic, cash flow forecasting.
Yeah, absolutely vital. So our plan for this deep dive is to unpack the information we've got here to help you understand just how fundamental cash is for any business, like for its actual survival.
And how looking ahead, forecasting its movement, can really be a game changer. It helps avoid some serious problems.
Definitely. Think of cash as the lifeblood of a business.
Exactly. And anticipating how it flows in and out is key to staying afloat, maybe even thriving.
And just quickly, if you want to explore more on this, you can always check out www.igce-business.weebly.com.
Yeah, lots more resources there on cash flow and other business topics too. Okay, should we dive in?
Let's do it. First things first. Let's talk about why cash is just so important. It sounds simple, maybe obvious, but it underpins everything.
It really does. Businesses need cash, like actual money, every single day, just to keep the doors open.
Mm-hmm. The sources give some good examples. Think about paying suppliers for materials or stock. You need cash now for that.
Right. Or paying overheads. Things like rent for your shop or factory,
Yeah.
insurance bills, the electricity to keep the lights on.
All need paying regularly. And maybe most critically, you need cash to pay your employees their wages each week or month.
Imagine not being able to pay your staff or your main supplier. Things would grind to a halt pretty fast, wouldn't they?
Oh, incredibly quickly. And this leads to a really serious point the source material highlights, the consequence of actually running out of cash. That word is insolvency.
Okay, insolvency. What does that mean exactly?
Well, it's when a business simply cannot pay its debts as they fall due.
Yeah.
Bills arrive, payments are needed, but there just isn't enough money in the bank account to cover them.
It's not just like a temporary tight spot then.
No, it's more serious. It's a state where the business can't meet its financial obligations. And the source points out this often leads directly to business failure.
And here's the bit that can be tricky but is so important. A business can actually be profitable,
Yep, making more money from sales than its costs over a period.
but still fail because it runs out of cash right now.
Exactly. That's the crunch point. Profit is calculated over time, say, a year. Cash is about the money you have available today.
Okay, so let's dig into that difference. The source material is really clear that cash and profit are not the same thing, especially at the end of a trading period. Why are they different?
This is like fundamental. Okay, reason one the source gives, selling goods on credit.
Ah, so you make a sale, it counts towards your profit calculation.
Right. Say you sell 1,000 pounds worth of goods. Maybe 400 pounds of that is profit. Great, your profit figure looks better.
But you haven't actually received the 1,000 pounds cash yet.
Precisely. If you've given the customer, say, 30 days to pay, that cash won't arrive for a month. So you have profit on paper, but the cash inflow is delayed.
That's called trade receivables, isn't it? Money owed to you.
Yes. And if too much of your money is tied up in receivables or customers pay late, even a profitable business can suddenly find it has no cash to pay its own bills.
Wow. So you could look great on the profit statement, but have an empty bank account. Okay, what else causes this difference?
Well, the owner might put more money into the business, their own savings, perhaps.
Right, an injection of capital.
Yeah. Say they put in 5,000 pounds. The cash balance goes up by 5,000 pounds straight away. But has the business earned that through trading?
No, it's not profit from operations, it's investment.
Okay, makes sense.
Then there's buying fixed assets, big ticket items.
Like machinery or a delivery van.
Exactly. You might spend, say, 20,000 pounds cash today on a new machine. Your cash balance takes a big hit.
But that 20,000 pounds cost isn't usually knocked off your profit calculation all in one go for that year, is it?
No, usually it's spread over the asset's useful life, something called depreciation. So the impact on profit in that specific period might be much smaller than the actual cash outflow. Ah, okay. So the accounting for profit is different from the actual cash movement for those big purchases.
Correct. And one more from the source. Borrowing money.
Like getting a bank loan.
Yeah. You get a 10,000 pound loan. Your cash balance jumps up by 10,000 pounds. Good news for your cash position.
But it's not profit, is it? It's debt. You have to pay it back.
Exactly. It boosts cash, but it's a liability, not profit earned from trading.
So just to recap then, you can have profit but no cash if your customers haven't paid you yet or you spent cash on big assets.
Right. Or you can have cash, but maybe not much profit if the owner put money in or you got a loan.
Or maybe you just started and haven't made many sales yet.
Yeah. Understanding this difference is absolutely critical. And that's why businesses need to track the actual movement of money.
Which brings us to the key cash flow concepts the source talks about, the actual flow.
Yep. Money coming in and money going out. Let's start with cash inflow.
Money coming into the business.
Exactly. The main one, hopefully, is sales revenue customers paying you. But the source also mentions inflows like getting that bank loan we talked about.
Or the owner putting in capital.
Right. Or maybe receiving interest, or even selling off an old asset you don't need anymore. Anything bringing cash in.
Okay, so that's inflow.
Yeah.
Filling the tank. Then cash outflow is the opposite. Money leaving.
Correct. Paying out cash. We've mentioned lots already. Paying wages, buying materials or stock,
Paying the electricity bill, the rent.
buying those fixed assets like machinery, paying taxes, all examples of cash flowing out of the business. Draining the tank.
Got it. Inflow in, outflow out. So how do we measure the difference over, say, a month?
That's where net cash flow comes in. The source defines it simply as total cash inflows minus total cash outflows for that period.
Okay, inflows minus outflows equals net cash flow. So if it's positive,
More cash came in than went out during that month. Your cash position improved.
and if it's negative.
More cash went out than came in. Your cash balance decreased over the month.
Right. So how does this link month to month? We need a starting point, don't we?
We do. That's the opening balance.
Maybe.
It's just the amount of cash the business has at the very beginning of the period, say day one of the month.
And the closing balance is what's left at the end.
Yep. You take your opening balance, add the net cash flow for the month, or subtract it if the net flow was negative.
And that gives you the closing balance, the cash you have at the end of the month.
And the crucial link the source highlights, that closing balance from 1 month becomes the opening balance for the next month. It keeps rolling forward.
Okay, that makes sense for tracking what has happened. But businesses need to look forward, right?
Absolutely. And that is precisely what a cash flow forecast is for.
Okay, so what is it according to the source?
It's defined as a financial document that predicts, and prediction is the key word here. It's an estimate the expected cash coming in, receipts or inflows,
Well-
and the expected cash going out, payments or outflows, over a future period.
Usually month by month, maybe for the next 6 months or a year ahead.
Typically, yes. It's taking those ideas of inflow, outflow, net cash flow, opening and closing balance, and applying them to what you think is going to happen.
And the main goal is to predict the likely cash balance at the end of each future month.
That's the core purpose, to anticipate your future cash position. So, given everything we've said about how vital cash is, why is creating one of these forecasts so important? What are the benefits?
The source lists a few key reasons. Let's break them down. First one sounds critical. Identifying cash shortages.
Yeah, this is huge. Because the forecast looks ahead, it can act like an early warning system.
How so?
Well, if you predict that, say, in 3 months, your outflows are likely to be much bigger than your inflows, and your starting cash for that month won't cover the difference.
The forecast shows you might run out of money before it actually happens.
Exactly. It flags up potential negative closing balances or dangerously low points in the future, and that gives you time.
Time to react, to plan.
Yes. Time to maybe arrange an overdraft with the bank, or chase up customers who owe you money more urgently, or maybe delay buying that piece of equipment you were planning on. You can take action before the crisis hits.
Definitely better than panicking when the bank account is empty.
Yeah.
Okay, what's the second benefit the source mentions?
Supporting applications for funding. So if you need to borrow money,
Like a bank loan or an overdraft facility?
yeah, the lender, usually the bank, will almost certainly ask to see your cash flow forecast.
Why do they need that?
They want to see if you're likely to be able to pay them back. The forecast shows your predicted cash position month by month. It shows you've planned.
And hopefully shows you'll have enough cash coming in down the line to make the loan repayments plus the interest.
Precisely. It helps the bank judge the risk. It shows you have a credible plan for managing the money.
It makes sense. It's like proof you've thought it through. What else?
The source also says creating a forecast helps generally with planning the business.
How does it do that?
Just the process of sitting down and thinking, okay, what sales do I realistically expect each month? What are all the costs I'll have to pay out? It forces you to be really specific about the financial side of your plans.
Turns vague ideas into actual numbers.
Exactly. It might highlight months where cash will be tight because of big bills, or periods where you really need sales to hit a certain level. It can make you rethink things, maybe find ways to cut costs before you start.
So it forces detailed financial thinking. Okay, and the last benefit.
Monitoring cash flow. The forecast isn't just a one-off exercise, you use it.
How? By comparing it to what actually happens.
Yes. As each month goes by, you compare the actual cash inflows and outflows to what you forecasted.
And if they're different, which they probably will be sometimes.
Well, if there are big differences, you need to ask why. Were sales much lower than expected? Why? Did costs suddenly jump up? What caused it?
So it helps you understand what's really going on.
Exactly. It helps you learn, spot problems or trends, maybe adjust your plans, and definitely improve your forecasting for the next time. It's a control tool as well as a planning tool.
So planning ahead, getting money, general business thinking, and checking how things are going seems pretty essential.
It really is. And the source stresses this is important for all businesses, big or small. Running out of cash, as we said, can be fatal.
Okay, we've covered some really important ground there, straight from the source material. Importance of cash, the cash versus profit difference, defining the flows, and why forecasting is key.
Yep, lots of core ideas.
Before we wrap up, maybe a quick check-in, just a few quick questions based purely on what we've discussed from the source.
Sounds good. Let's test ourselves.
Okay, first one. True or false? If a business is making a healthy profit, it definitely won't run out of cash.
Remember those differences.
Question 2. Can you give just one example of a cash inflow, according to the source material? Money coming in.
Think about where cash originates.
And following that, one example of a cash outflow, money going out.
What does a business spend cash on?
And finally, thinking about those benefits we just discussed, name one main reason why a business should create a cash flow forecast.
What's a key advantage it gives them?
Okay, hopefully running through those helps cement the main points.
Definitely. So, to quickly summarize our deep dive today, the sources make it crystal clear that cash is absolutely vital for day-to-day survival.
And running out can lead to insolvency, even if you're profitable on paper.
And understanding why cash differs from profit because of credit sales, asset buys, loans, owner's capital is fundamental.
And that leads us to the cash flow forecast, that prediction of future cash movements. It's a crucial tool.
Yeah, for spotting shortages early, getting funding, improving planning, and monitoring how things are actually going against the plan.
Okay, so here's a final thought, something for you to maybe mull over after this. We talked about forecasting the expected things, but what about the unexpected? How might external factors, things outside the business's control, like say a sudden drop in customer demand, or maybe a key supplier suddenly hikes their prices, how could that mess up a carefully planned cash flow forecast?
Ooh, good question. Those kinds of shocks happen.
And thinking further, what could a business maybe do, using its knowledge of cash flow, to try and prepare for, or at least react better to, those kinds of unpredictable hits?
Building some financial resilience. Interesting angle.
Something to think about.
Yeah.
And just a final reminder, for more resources on all this, do visit www.igcec-business.weebly.com.
Definitely worth checking out for more detail.
Well, thank you for joining us on this deep dive into cash flow forecasting.
We hope it's given you a clearer picture of why cash is king and why planning its future is so important for business success.